What if I told you that the difference between struggling financially and becoming mega wealthy is not just about working harder, but thinking smarter? Imagine two people. One earns a high salary but constantly struggles with expenses, while the other, with a modest income, ends up financially free. The key difference? A wealth-building mindset. Welcome to Megawealth, Investing by Emmy Sobieski, a book that shatters conventional wisdom and lays down the real strategies for long-term, exponential wealth creation. In this audiobook summary by AudiblePages, we'll break down Sobieski's key principles and lessons, from the investor mindset to strategic asset allocation, from taking calculated risks to capitalizing on long-term trends. And don't worry, I'll keep it fun, engaging, and packed with actionable insights so you can start making smarter money moves today. Chapter 1. The Megawealth Mentality. Wealth isn't about luck, it's about mindset. Sobieski argues that truly wealthy individuals see the world differently. Instead of focusing on saving pennies, they focus on acquiring assets that generate value. This means shifting from scarcity mindset, where money is finite, to an abundance mindset, where opportunities to grow wealth are limitless. Key lessons. Money is a tool, not a goal. The wealthy don't hoard cash. They invest it in assets that appreciate over time. Think in decades, not days. Short-term thinking leads to panic-driven decisions. Long-term investing requires patience and vision. Embrace risk intelligently. The difference between a risky bet and a calculated risk is education and preparation. Consider the story of two friends, Jake and Mark. Both earn $100,000 a year. Jake saves 20% in a traditional bank account with minimal interest, while Mark invests in stocks and real estate. 10 years later, Jake has about $200,000 in savings, while Mark's investments have grown to over $500,000. The lesson? Smart money grows. Idle money loses value over time. Actionable insight. Start viewing every dollar as an investment tool. Ask yourself, is this dollar being used to grow, or is it being wasted? Chapter 2. The Power of Compounding and Long-Term Investing. Albert Einstein called compound interest the eighth wonder of the world, and for good reason. Sobieski emphasizes that time in the market is more important than timing the market. The earlier you start, the better. Key lessons. The magic of compounding. A single $10,000 investment at an 8% annual return becomes over $100,000 in 30 years. Small, consistent investments snowball into massive wealth. Don't chase quick wins. Trying to time the market or chase hot stocks usually leads to losses. Focus on steady, long-term growth. Reinvest, reinvest, reinvest. Always reinvest your dividends and earnings to maximize compounding effects. Let's take the example of two investors. Sarah starts investing $200 a month at age 25. Tom starts at 40, investing $500 monthly. Even though Tom invests more each month, by the time they both reach 65, Sarah has significantly more wealth because her money had more time to compound. The moral? Start now, no matter how small. Actionable insight. Automate your investments. Set up a recurring investment plan in index funds or blue-chip stocks, and let compound growth work for you. Chapter 3. Asset Allocation. The wealthy secret weapon. It's not just about what you invest in, it's about how you diversify. Sobieski breaks down asset allocation strategies that balance risk and reward. Key lessons. Diversify smartly. Spread investments across stocks, real estate, private equity, and alternative assets. Don't put all your eggs in one basket, but don't spread too thin. Focus on a handful of high-quality investments rather than too many random ones. Adjust based on life stages. Younger investors can afford higher risks, while older investors should focus on wealth preservation. A classic example of failed asset allocation is the 2008 financial crisis. Many investors had too much exposure to real estate without balancing their portfolios. When the market crashed, they lost everything. Meanwhile, diversified investors who had exposure to bonds, commodities, and tech stocks recovered much faster. Actionable insight. Review your portfolio. Are you too concentrated in one area? Rebalance based on your risk tolerance and financial goals. Chapter 4. Risk management and psychological resilience. Even the best investors make mistakes. The difference is how they handle losses. Sobieski stresses the importance of emotional discipline in investing. Key lessons. Avoid emotional investing. Fear and greed drive most financial mistakes. Stick to logic and strategy. Losses are part of the game. Instead of panicking over a downturn, see it as a buying opportunity. Have an exit plan. Set rules for when to sell to avoid making rash decisions. A study showed that during market downturns, amateur investors tend to sell in panic, while seasoned investors see downturns as a chance to buy discounted assets. Warren Buffett's famous advice: be fearful when others are greedy, and greedy when others are fearful. Actionable insight. Write down your investment strategy and stick to it. When emotions rise, refer to your plan rather than making knee-jerk reactions. Chapter 5. The Future of Investing. Where wealth is headed. Sobieski urges investors to keep an eye on future trends. What industries are poised for exponential growth? Where is technology taking us? Key lessons. Follow innovation. AI, blockchain, biotech, and sustainable energy are industries of the future. Don't fight the macro trends. Instead of resisting economic shifts, position yourself to benefit from them. Be adaptable. The best investors aren't stuck in the past. They adjust to new opportunities. Think of the early investors in Amazon, Tesla, or Bitcoin. They saw future trends before the masses. Investing in trends like AI, green energy, and automation today may yield similar exponential returns in the coming decades. Actionable insight. Research emerging industries. Are you invested in future-forward sectors, or are you clinging to outdated ones? Conclusion. Your path to Megawealth starts now. Becoming a Megawealth investor doesn't require a PhD in finance. It requires a shift in thinking, a commitment to long-term growth, and the ability to act consistently over time. If there's one takeaway from Sobieski's book, it's this: wealth isn't reserved for the elite. It's built by those who understand the principles of smart investing and execute them with discipline. Final thought. What action will you take today? Will you start investing, review your portfolio, or educate yourself further? The path to Megawealth is open to anyone willing to take that first step. Now, go out there and start building your financial empire.